You know, some of the greatest financial lessons come from people who face the toughest storms in life. Benjamin Graham, born in 1894 as Benjamin Grosbaum in London, had no easy start. His family, hopeful for better opportunities, moved to New York, only to face tragedy when young Ben lost his father at the age of 9. Suddenly, the weight of survival fell on him and his brothers. They had to hustle, taking whatever jobs they could find, just to keep the family afloat. Yet even in this hardship, Graham's mind was sharpening in ways most adults never experience. At 13, Ben got his first taste of the stock market, an experience that could have discouraged anyone. His widowed mother invested in US Steel, and then the panic of 1907 wiped nearly half the value of her stake. Most would have seen disaster, but young Ben began learning one of the most critical lessons of investing. The market doesn't care about your feelings. It moves whether you're ready or not. He would remember that moment for the rest of his life. By the time he graduated from Columbia University in 1914, Graham had already endured setbacks that would have broken many. Mistaken test scores had delayed his acceptance, and he even had to learn to swim to graduate. Yet these hurdles only reinforced his discipline, patience, and resilience, traits that would later define his approach to investing. Early on, he realized that success wasn't about luck. It was about preparation, research, and understanding the numbers behind every opportunity. Graham's first job on Wall Street wasn't glamorous. He earned a mere $12 per week as a runner at Neuberger, Henderson and Loeb. But even in these humble beginnings, he demonstrated an uncanny talent for financial analysis. A month later, he was assisting in the bond department, dissecting complex accounting statements while the world around him seemed to crumble. World War I broke out. A panic hit the New York Stock Exchange, and his salary was slashed. But Ben persisted. When Botch and Company noticed his reports, they offered him $18 per week. Ben was learning a timeless lesson. Skill combined with opportunity always pays off. By 1920, at the age of 26, Graham became a junior partner at Neuberger, earning a share of profits without liability for losses. The Roaring Twenties provided fertile ground for his investment strategies, and he began experimenting with complex deals, buying bonds and preferred shares that others deemed risky. His reputation as an innovative thinker on Wall Street was growing, and his keen eye for undervalued securities was sharpening. In 1923, Graham was offered management of $250,000 by a major investor, with an enticing arrangement: a guaranteed return for the client, a salary for him, and profit sharing above that return. This was the start of a model that would evolve into structures remarkably similar to modern hedge funds. Graham's focus wasn't just on wealth. He wanted to align incentives with his clients, ensuring that profits came with responsibility. By carefully structuring deals, he minimized risk while maximizing upside, a hallmark of value investing that would define his career. Graham's early years as a money manager were a mix of triumph and caution. The late 1920s bull market provided enormous returns, propelling him close to his first million. But the 1929 crash was a brutal lesson. Stocks plunged and investors panicked. Yet, Graham's disciplined approach allowed him to weather the storm, learning the ultimate truth. Margin of safety is not just a principle, it's survival. By the early 1930s, Graham had refined his strategies and taught them at Columbia University, gaining both students and clients. His articles and lectures laid the foundation for a new, scientific approach to investing, separating speculation from analysis. He was no longer just chasing quick gains. He was building a systematic method to identify true value in companies, a strategy that would serve him for decades. Benjamin Graham's reputation on Wall Street was soaring by the mid-1930s after surviving the Great Depression with lessons etched into his methodology. He partnered with Jerry Newman, the brother of a childhood friend, to form the Graham-Newman Corporation in 1936. This partnership marked a turning point. Now, Graham could focus purely on investing, while Newman handled the business and administrative side. The company started with about $3 million in assets under management, a massive sum for the time, and Graham's compensation was structured to reward performance. A modest salary, plus a percentage of profits above a guaranteed return for investors. This setup not only incentivized smart investing but also gave Graham the freedom to implement the strategies he had been perfecting for decades. Graham was methodical. He divided investments into 4 distinct categories: arbitrages, bargain issues, liquidations, and related hedges. Each category followed a strict set of rules designed to maximize upside while limiting downside. For example, in arbitrages, Graham would spot opportunities where a company's assets or transactions were mispriced relative to market value, creating near risk-free profit potential. In bargain issues, he purchased stocks trading below intrinsic value, often supported by dividends and underlying assets like bonds. Liquidations allowed him to profit from companies winding down operations, and related hedges used convertible securities to exploit pricing inefficiencies. Each move was backed by careful analysis, never guesswork or speculation. By the late 1940s, Graham had accumulated a wealth of experience and a growing client base. But it wasn't just his methods that set him apart. It was his mindset. He understood the stock market as a system influenced as much by human psychology as by numbers. The infamous Mr. Market, a term Graham coined, illustrated this perfectly. The market swings between extreme optimism and extreme pessimism, presenting opportunities for disciplined investors. Graham learned to remain calm when others panicked and to act decisively when others hesitated. This psychological edge proved invaluable during volatile periods, especially as the post-war market began to surge. One of Graham's most pivotal investments was in GEICO, an insurance company that many overlooked at the time. In 1948, the Graham-Newman Corporation acquired a 50% interest, using roughly a quarter of the company's assets. This was not a reckless gamble. It was a calculated decision based on intrinsic value, potential growth, and market inefficiencies. Graham even became the chairman of GEICO between 1949 and 1957. The investment was transformative. As GEICO grew, its value skyrocketed, and Graham's personal fortune surged alongside it. This single decision, grounded in analysis and patience, eventually contributed more to his wealth than any other deal in his career. Meanwhile, Graham continued teaching at Columbia University, refining his theories and sharing insights with a new generation of investors. His 1934 book, Security Analysis, co-authored with David Dodd, became a cornerstone of modern investing. Selling over 100,000 copies in its first 40 years, the book was not only an intellectual triumph, but also a financial one, adding another revenue stream that contributed to his eventual millionaire status. Through teaching, writing, and hands-on investing, Graham's influence spread, inspiring future legends like Warren Buffett. By the early 1950s, Graham's wealth had begun to crystallize. His joint account and the Graham-Newman Corporation had compounded steadily, and the combination of book royalties, management fees, and successful stock holdings pushed his net worth closer to $1,000,000. Importantly, Graham's approach remained consistent, never over-leveraging, always prioritizing intrinsic value and keeping a margin of safety in every investment. Even after decades on Wall Street, these principles guided every decision. allowing him to navigate bull markets, bear markets, and periods of extreme uncertainty. The late 1940s and early 1950s marked the culmination of Graham's journey to his first million. It was not sudden luck, inheritance, or speculation. It was a combination of relentless study, disciplined methodology, patience, and the ability to seize opportunities when others were blinded by fear or greed. By 1953, historians estimate, Benjamin Graham had officially crossed the $1,000 milestone. Adjusted for inflation, that figure would be equivalent to over $11 million. Today, a testament to the power of intelligent investing, perseverance, and strategic thinking, Graham's story is more than numbers. It is a lesson in resilience and mindset. From a fatherless immigrant boy to a Wall Street innovator, he demonstrated that success is rarely instantaneous. It requires mastering fundamentals, developing a systematic approach, and learning to act rationally when emotions run high. The mistakes of early investors, the shocks of economic crashes, and the volatile swings of Mr. Market all became teaching tools that Graham transformed into actionable strategies. Even as he reached financial milestones, Graham never lost sight of principles. He emphasized modest living, disciplined savings, and ethical responsibility to clients. His philosophy was clear. Wealth was not just about accumulation. It was about security, freedom, and the ability to make rational choices without being enslaved by fear or greed. These values, coupled with his analytical brilliance, cemented his legacy as the father of value investing and a mentor to generations of investors. By the mid-1950s, Benjamin Graham had reached the pinnacle of his early financial journey. His book Royalties, combined with the success of the Graham-Newman Corporation and his strategic investment in GEICO, had solidified his position as a millionaire. But the real story wasn't just the numbers, it was how he reached them. Graham's wealth accumulation was a product of methodical planning, disciplined risk management, and a deep understanding of market psychology. He never relied on luck alone, nor did he chase speculative trends. Every move was deliberate, supported by research, historical precedent, and a clear margin of safety. One of Graham's most remarkable traits was his ability to separate emotion from investing. The stock market, he realized, was driven as much by human behavior as by economic fundamentals. Prices fluctuated wildly, influenced by fear, greed, and irrational expectations. While others panicked during downturns, Graham saw opportunity. He taught that the key to long-term wealth wasn't timing the market perfectly, but staying rational and disciplined, buying undervalued assets, and allowing compounding to work its magic over time. This principle, which he famously articulated through his Mr. Market analogy, became the foundation of value investing. The GEICO investment serves as a prime example. At a time when many investors overlooked the company, Graham recognized its intrinsic value and growth potential. His decision to allocate a significant portion of Graham-Newman's assets to GEICO was calculated yet bold. It demonstrated his willingness to take concentrated, intelligent risks when the probabilities were clearly in his favor. As GEICO's fortunes soared, so did Graham's personal wealth, proving that understanding a business deeply often yields far greater rewards than following market hype. Meanwhile, Graham continued to educate future investors. His teaching at Columbia University and his seminal books, Security Analysis and The Intelligent Investor, became enduring pillars of investing knowledge. These works emphasize not just technical skill but also the ethical responsibility of investors to act rationally and prudently. By codifying his methods, Graham ensured that the principles he lived by could guide others long after his own financial journey. By 1953, Benjamin Graham had crossed the $1,000 milestone. But unlike many who reach financial success, he did so with humility, discipline, and foresight. He understood that wealth, once achieved, must be preserved through intelligent decision-making rather than flaunted or recklessly spent. He lived modestly, reinvested profits strategically, and maintained a long-term perspective on both life and investing. His approach combined practical skill, psychological insight, and ethical responsibility, a framework that remains relevant even today. Graham's journey offers timeless lessons for modern investors. First, education and preparation matter more than luck. Graham studied relentlessly, mastered accounting and finance, and understood markets in a way few could. Second, patience and discipline are paramount. Wealth is rarely built overnight. It compounds steadily when decisions are rational and consistent. Third, risk management is essential. By always maintaining a margin of safety, Graham protected himself from catastrophic losses and ensured long-term growth. Fourth, opportunity favors the prepared mind. The Geico investment exemplifies this. He acted decisively when others hesitated, reaping rewards that far exceeded typical market returns. Finally, Graham's story reminds us that investing is both a science and an art. Numbers and analysis matter, but so does temperament, discipline, and the ability to detach from fear and greed. By combining rigorous methodology with emotional intelligence, Graham transformed from a broke immigrant child into a millionaire and a mentor to generations of investors, including Warren Buffett, who would call him by far the best teacher of investing I ever had. Benjamin Graham's first $1,000 was not just a milestone, it was a testament to the power of knowledge, resilience, and strategic thinking. His life illustrates that true financial success is not about chasing wealth blindly, but about mastering principles, staying disciplined, and making informed decisions. Every aspiring investor today can learn from his journey. Study diligently, think critically, act rationally, and always protect against unnecessary risk. So whether you are just starting out with small savings or managing millions, Graham's story offers a blueprint for wealth that transcends time, markets, and generations. His journey proves that even in the harshest economic conditions, with the right mindset, strategy, and discipline, reaching your first million and far beyond is not only possible but achievable. You know, that's the true power of value investing. It's about understanding businesses, mastering yourself, and staying patient while the market eventually recognizes the value you already saw. Benjamin Graham didn't just make his first million. He created a legacy that teaches us how to think, act, and thrive financially in a world full of uncertainty. And that lesson, more than the money, is what makes his story timeless.